Let's also welcome Nilesh Shah from Axis Direct as well. Nilesh Shah, just want to get you in on the point about the market, because we've been bouncing in somewhat of a range, barring today, of course, for the last 3 months. When do you think we will snap out of this?
I still believe that markets are unlikely to move in a particular direction in the near term. However, over medium term, it may start having upward bias. The reason why markets will not give very sharp correction from current level is purely the valuation. We are today trading at about 13 times 1 year forward earning, which is exactly same where US S&P 500 is trading. Now let's look at our situation vis-a-vis US. They have problems of high fiscal deficit, higher than India. Their debt to GDP ratio is higher than India. Their unemployment levels are rising. And in that kind of scenario, their growth rate, which is supported by pretty loose monetary policy from US Fed and pretty loose fiscal policy from the government of America, is supporting a reasonable level of growth, which is going to be far, far lower than India. So a country like US is trading at the same valuation like India, with higher fiscal deficit, with higher debt to GDP ratio and lower growth. It's essentially the perception or comfort which investors have about American corporates. Now, same thing will eventually get developed for India, which is having lower deficit, lower debt to GDP, higher earnings growth, higher GDP growth. But there are concerns in the minds of investors because of issues related to tax, because of issues related to currency. Over a period of time, we will be in a position to sort them out, and that should result into re-rating or upward bias of our market. But in the near term, till such time we solve the issues on currency, on the taxation, and on the growth, probably markets are not going to go either up or down by a meaningful margin.
Nilesh, in the last 3 years, the Indian markets or benchmark indices have been flat. Policy regime has not improved at all, inflation is high, and earnings are clearly slowing down. Do you think foreign institutional investors who so far have kept their faith in India, they are now losing their faith?
Over the last 3 years, the highest ever FII inflows of under $9 billion came in Jan to March 2012 quarter. Yes, in April they have withdrawn about $140 million, but even on Friday, when markets corrected 300 points, FIIs were net buyers of $100 million. So clearly the inflow does not indicate this hypothesis that FIIs are frustrated with India and FIIs are quitting India. If we see FIIs ownership of India at 18.4%, it's probably again highest in the last 3 years and almost nearer to all-time high level. Clearly that also does not reflect FIIs' frustration. This is not to show that FIIs are not frustrated. Certainly over the last 5 years, Indian equity has not given return and currency depreciation has given them some amount of pain. The perception about Indian policy actions, perception about Indian regulations impacting certain sectors like telecom and power, certainly these are all the issues which are concerning FIIs. But does that mean that they will go out lock, stock and barrel? That's not going to be the case. If we take action in terms of managing our currency better, if we take action in terms of resolving their concerns on taxation related issues, if we take steps in terms of promoting growth in certain sectors and overall economy, then certainly FIIs will be more than happy to come back to India.
Nilesh, since the finance bill is going to be tabled in the parliament today and that is also going to include the GAR provision, what do you think, or rather how will the markets react given the two scenarios? What happens when GAR is retrospective and what if it's not?
I think let's first look at the GAR per se. It's not a law which is being introduced in India for the first time. It is an established law across many developed markets. It is prevalent in many geographies. So it is not that we are the first country who is introducing this law. The second thing is FII's concern about retrospective implementation of this tax law and the kind of authority it gives in the hands of tax inspector to levy tax. If government can address this concern about retrospective application of this law, about how this law will be applied in a true and fair manner, I think a lot of concerns which FIIs have related to GAR will go away. One of the concerns which is concerning them is how do you define investment through Mauritius by way of an establishment present in Mauritius or by way of a pass-through establishment in Mauritius. If we can come out with a clear rule which defines that if you comply with 1, 2 and 3 conditions, you will be defined as a permanent establishment in Mauritius, and if you don't comply with that, you will be considered as a pass-through vehicle, and hence you will be kind of charged taxation according to Indian law. I think that clear-cut direction, that clear-cut guideline will take up a lot of concerns which is there on GAR, and then probably FIIs will be looking positively to Indian market. That positiveness will have to sustain by announcing some amount of reforms on the growth side, by following probably a little bit loose monetary policy, and kind of creating a conducive environment where earnings growth returns, where overall economic growth returns, and people believe that yes, here is a country where if I invest my money over a period of time, I'll generate a better return.
Nilesh, market insiders are telling me that telecom clearly seems to be a top contra bet for FY13. What makes you bullish on telecom at a time when the entire sector is structurally plagued by a lot of policy problems?
Yes, I think it's time to accumulate telecom stock. In terms of negativity, telecom sectors have priced down recent TRAI recommendations in terms of higher license fees. It has also factored in the cancellation of 2G licenses. So in some sense, most of the negative news which could come for telecom sector has already been priced in. There was a severe competition in telecom sector which also resulted into severe drop in the profitability of telecom companies, which have bottomed out somewhere towards 2011-2012, and going forward that competitiveness probably will start declining, which will help them increase their prices. So put all those things together, yes, this is the time to accumulate telecom sector stocks, but don't be in a hurry to accumulate, because we will continue to get some bad news in this sector on a regular basis over a couple of months. We'll have to buy on a day when telecom stocks have fallen rather than when they have risen.
So Nilesh, for investors sitting on cash, should they invest at these levels or should they wait, and you think that the market is going to throw some better opportunities?
My feeling is that not only telecom sector but the overall market, it might be worth buying when the bad news is there and when the prices are falling. Probably for some time to come we are going to see a range bound market which will keep on moving volatile in the ups and downs in a very, very narrow range. In the near term, we are going to see probably issues coming back in Europe as the Greece and France votes for the new government. We'll probably see some amount of concerns coming back in US because the recent numbers have slowed down. We will probably see some amount of volatility emerging because of concerns relating to GAR and slowdown of reforms in India. So all those things put together will cap the upside. On the downside, we will see protection coming essentially because of valuation, and the fact is that there's no new supply emerging at this levels of valuation. So in such kind of scenario where markets are likely to be behaving in a range-bound fashion, but albeit in a volatile manner, it will be best to buy when the prices are falling and bad news are flashing across the channels. But when the prices are rising and when good news are appearing, probably one can avoid the temptation of buying. Catching the falling knife, buying when the prices are correcting, buying when the markets are falling, I think that strategy will work well.
Nilesh, now there is a reason why consumer stocks are moving up. They have stable business model, zero debt, strong return on equity. But at these levels, are consumer stocks pricing in a near perfect scenario?
I think in the consumer stock, they have been at a reasonably high valuation, and this high valuation partly is coming from the fact that these are the businesses where pricing power is there. These are the businesses where no new fresh supply of capital is going to come. So lack of fresh supply along with reasonably steady business model kind of gives the comfort to the investors to buy the stocks even at this high valuation. If you see the history of consumer stock, there are stocks which have corrected significantly when they reached a valuation level which was unsustainable. So my feeling is that at current level of valuation, some of the consumer stock could also go through that cycle. However, for investors who are already invested into consumer stock, they may probably want to hold on to this stock because you are not going to see fresh supply emerging on these companies. We probably will see time correction in consumer stock rather than price correction because of lack of supply.
So Nilesh, from a 6-month to 1 year and 3 year perspective, which asset classes are you betting on?
On a 6 months basis, I will recommend fixed maturity plan. You know your return almost in accurate basis. This is not the time frame to invest into equities or gold or other interest rate risk bearing fixed income securities. So for 6 months, go to the fixed maturity plan. On a 1 year basis, one can look at short term plans. The current short term yields are reasonably high. We expect policy rates to come down over next 12 months. The correction in the policy rates will give some amount of capital appreciation to the short term funds. So you will benefit not only from current high carry, but also from the capital appreciation. On a 3 year basis, certainly one should look at equities. Don't invest at one go. Invest on a gradual basis over next 3 to 6 months. Buy when the markets are correcting, when the prices are falling, rather than when prices are rising. So 6 months FMP, 1 year short term plan, 3 year large cap equity.